Welcome back. Attorney Andrew Bethel of Bethel Law, where we talk estate planning, finances, real estate, and taxes, here once again with the Q&A where I answer your questions you leave on our videos or that you actually call in and ask me about. I have 3 questions for you today, and as usual, I try to keep them all on theme. Today's theme is taxes. Capital gains, inheritance, and gift taxes to be precise. Please honor your New Year's resolution to subscribe to this channel, hit the like button, and share just one of our videos with a friend or family. I hope you had a happy holidays, and let's dive in. Our first question is from someone asking for clarification on capital gains tax basis. When does it transfer? When does it step up? And what does it mean for you at tax time? The question is from one of our most popular videos on how to minimize inheritance, estate, and capital gains taxes. The potential capital gains tax exposure I was referring to in that video is the fact that if one gifts property to another during their lifetime, as in not an inheritance, then the person doing the giving, the donor, is also transferring over their capital gains tax basis to the recipient, the donee. A capital gains tax is a tax on the difference between what you acquired the property for, the tax basis, and what you sold it for. Let's say you bought a house for $100,000 and sold it for $400,000 years later. Your basis is $100,000 and the house appreciated by $300,000. Once you sell that property, you've made a gain of $300,000 and the government wants a piece of that appreciation, that $300,000. 0, 15, or 20% based on your income bracket. However, if someone inherits property, then they receive a stepped up basis to the date of death value, meaning that the beneficiary's tax basis for capital gains is the date of death value rather than the original owner's purchase price. However, if the recipient received the property as a gift during the original owner's lifetime, then there is no step up in basis. Thus, if the recipient then sells the property, their tax basis will be the same as the original owner's, the initial purchase price. The next question is from Jerry, who received the gift of a home, but now has potential capital gains to contend with. I was gifted a house by my parents. I'm screwed on the capital gains, right? My accountant told me I should be okay because I'm not making over a certain amount of money, multiple millions. Anyway, what are your thoughts? From my understanding of Jerry's tax situation, which admittedly may be limited due to me being an attorney, not a CPA or EA, is that our friend here is stuck with the initial tax basis of his parents on the property. Due to this, he will have to anticipate a big tax bill when he goes to sell the property. However, there may be 2 cases where Jerry or you can avoid or at least mitigate some taxes. If either you are considered low income by the IRS's standards or the property is your principal residence, then you may be able to avoid capital gains taxes. To be considered low income, you must either have a taxable income of up to $41,675 as a single filer or married filing separately, $83,350 for married filing jointly or qualified spouse, or $55,800 for head of household. If you fall into one of these brackets, then your long-term, more than 1 year of ownership, capital gains tax rate will likely be 0%. However, if the property is your principal residence and you realize a gain, the difference between the tax basis and net sales proceeds, then you have some capital gains tax credits to play with. $250,000 for individuals and $500,000 for married couples. This means you need to make more than this on the sale of your primary residence before capital gains taxes kick in anyway. Our last question is interesting. Regarding income financial gift taxes, when does a new year begin and what is the limit each year? Now, with government regulations and IRS tax regulations, you would think you would get a weird answer like April 14th or something, but nope. We just look at the calendar year, January 1st to December 31st. Anything given during a normal calendar year is to be considered as a gift during that calendar year. How much can someone gift and not have to worry about gift taxes is a value that varies with time. The yearly gift tax exclusion limit, how much you can give to a single person before a gift tax is owed by the giver, was raised for 2024 to $18,000. The lifetime gift tax exclusion limit, how much you can give in total during your lifetime before a gift tax is owed by the giver, is tied to the federal estate tax exemption level, which for 2024 is $13.61 million. This number will raise again next year as it's indexed to inflation. However, this standard will sunset in 2025 with the expiration of the 2017 Tax Cuts and Jobs Act to what the figures would have been under the Obama-era legislation, still indexed to inflation, and are expected to be around the $6 million range. With that, I'm attorney Andrew Bethel. Drop a comment below with your questions, like, subscribe, share the video. You know what to do. I'll see you next time.